Somewhere in Germany today, someone earning 25,000 euros a year is following the exact same financial playbook as someone earning 120,000 euros, and that's a massive problem. Because a strategy that makes perfect sense at 25,000 euros, like chasing every state benefit and aggressively clearing consumer debt, becomes a missed opportunity at 120,000 euros, where tax minimization and smart investment structures should be doing the heavy lifting. The advanced moves that save a high earner tens of thousands of euros are either unavailable or completely irrelevant if you're still building your foundation. Your income level determines your best next move, and most people get this wrong. So today I'm going to walk you through the best financial strategies based on what you actually earn right now in Germany. Let's start with the foundation. In the 2025 tax year, Germany uses a progressive income tax system that works like this. You pay nothing on the first 11,784 euros you earn. That's the Grundfreibetrag, the basic personal allowance. From 11,785 euros up to 66,760 euros, the rate starts at 14% and gradually rises to 42%. From 66,761 euros to 277,825 euros, you're in the flat 42% bracket. And anything above 277,826 euros gets taxed at 45%, the so-called Reichsteuer. On top of that, everyone pays the 5.5% solidarity surcharge on their income tax liability, though since 2021 this only applies to higher earners, and statutory pension, health, and unemployment insurance contributions can add another 20% or more to your total burden. The numbers are significant, and ignoring them is expensive. Now, if you're earning under 30,000 euros a year, your number one priority is building a financial floor beneath you. That means an emergency fund, 3 months of essential living expenses sitting in a Tagesgeldkonto, a daily access savings account. Top providers like DKB, ING, or Comdirect currently offer rates around 2.5% to 3% annually, which won't make you rich, but will stop you going into debt when life throws a curveball, and it always does. At this income level, the German state actually wants to help you build long-term wealth, and most people don't fully use the tools available. The Arbeitnehmer-Sparzulage is one of them. If your taxable income is below 40,000 euros as a single filer or 80,000 euros as a couple, the government will top up your capital-forming benefits by up to 80 euros per year when you direct part of your pay into qualifying investment plans. It's not life-changing on its own, but over decades the compounding effect adds up. The Wohnungsbauprämie is another. Save up to 700 euros per year into a Bausparvertrag, and the state adds a 10% bonus. That's 70 euro extra, again compounding over time. At this stage, debt is the silent wealth destroyer. If you're carrying credit card balances or installment credit from consumer purchases, every euro of interest is pulling you backward. Use the avalanche method. List your debts from highest interest rate to lowest. Throw everything extra at the top one while paying minimums on the rest, and roll each cleared payment into the next. It saves you the most money in interest over time. Now let's move up. If you're earning between 30,000 euros and 70,000 euros, you're in what I call the leverage zone. You've got enough income to make meaningful moves, but you're not yet in the zone where every strategy needs to be meticulously coordinated. This is where the Restaurant becomes relevant. If you're a statutory pension contributor, the state will pay you a base allowance of 175 euros per year into your Riester contract, plus 185 euros for each child born before 2008 or 300 euros for each child born after. To get the full allowance, you need to contribute at least 4% of your previous year's gross income minus the state bonus. For many people in this bracket, the Riester allowances alone provide a meaningful return on relatively small contributions. The Ruhrrent, also called Basisrente, deserves attention too. Contributions are tax-deductible up to 29,344 euros in 2025 for a single filer, reducing your taxable income at your marginal rate. If you're self-employed and lack access to a company pension, this is essential. This is also the income range where investing outside of pension wrappers should begin. Even 200 euros a month into a broadly diversified ETF, something like a MSCI World or MSCI All-Country World Index Fund through a low-cost broker like Trade Republic, scalable capital, or Flatex, starts compounding seriously over 10 to 15 years. The German Sparerpachtbetrag gives you €1,000 per year in tax-free investment returns as a single filer, €2,000 as a couple. So make sure your broker has your Freistellungsauftrag set up to capture that before you pay tax on anything. If you're earning between €70,000 and €120,000, the game changes. You're in the 42% bracket, and every euro of legitimate taxable income reduction has a direct and significant impact. Maximizing deductible expenses becomes critical. Work-related costs, professional development tied to your current role, home office deductions. Germany allows a flat €6 per home office day up to €1,260 per year, or actual costs if higher. All reduce your taxable income at your marginal rate. At this level, the betriebliche Altersvorsorge, or company pension scheme, becomes a powerful lever. You can contribute up to €604 per month in 2025 from your gross salary on a tax-free and Social Security-free basis. That's over €7,000 a year sheltered from both income tax and contributions. If your employer matches any of it, that's an instant return with no equivalent elsewhere. This is also where you should be thinking carefully about investment structures. A straightforward ETF portfolio or a real estate investment, direct or through REITs, can build serious long-term wealth at this tax rate. If you hold investments for more than 1 year, the Abgeltungssteuer flat tax of 26.375%, including solidarity surcharge, applies to capital gains, which is actually lower than your marginal rate. Another reason to prioritize investments over consumption. And then there's the top tier. If you're earning €150,000 or more, every strategy needs to be deliberate and coordinated. At 45% plus solidarity surcharge, nearly half of every additional euro disappears before you see it. Reducing taxable income isn't optional, it's essential. Maximizing your betriebliche Altersvorsorge contributions should be non-negotiable. Beyond that, high earners should seriously explore the GmbH structure for those with significant freelance or business income. Retaining profits inside a GmbH is taxed at roughly 30% rather than your personal marginal rate, creating a meaningful deferral advantage. Investment bonds and life insurance wrappers under Section 20 ESDG are another tool. Structured correctly, they allow internal compounding with deferred and reduced taxation on exit. Family wealth planning through gifts within the tax-free allowances, for €100,000 per parent per child every 10 years, can shift assets to lower tax family members entirely legally. The single biggest mistake high earners make is lifestyle inflation. Earning €200,000 means nothing if you're spending €195,000. The gap between what you earn and what you keep is the only number that matters. Set a savings rate target of at least 20 to 30% of gross income, automate it, and let time do the heavy lifting. No matter where you sit on the income scale, here's the truth. Wealth isn't built by earning more. It's built by keeping more of what you earn and putting it to work in the right places. The strategies change as your income grows, but the discipline stays the same. If this video gave you even one idea you can use today, smash that like button, share it with someone who needs to hear it, and subscribe to the channel. Thanks for watching, and I'll see you in the next one.